Good afternoon, everybody. Welcome to today's webinar. We'll get started in just a moment. My name is Marina Poljak, and I'm the event coordinator for the Windsor-Essex Regional Chamber of Commerce. We'll let everybody join and settle in. In the meantime, if you see my slide, we just want to give a couple of tips for you guys. So you can ask questions during this presentation. Leave them in the Q&A or the chat section. We will monitor those and they will be brought up in the Q&A portion of the webinar. As well, the webinar is recorded and will be made available for viewing by the end of this week on our YouTube channel and our website. So if you have any questions or feedback for the Chamber in general, or you'd like to send us recommendations for future webinars, send them to info@windsoressex-chamber.org. And for the latest helpful resources and links, we encourage you to go to our website, and we do have a COVID-19 tab specifically put up right now. Also, our social media is updated daily, and you can follow us on Twitter, Facebook, LinkedIn, Instagram, and view our previously recorded webinars on our YouTube channel. So we'll take another 30 seconds, and then I will pass it on to get the webinar started. Okay, at this time, I will pass it on to our Windsor-Essex Chamber President and CEO, Rakesh Naidu.
Good afternoon, everyone, and welcome back to the Business Briefs Interactive webinars. I want to first start off by paying my respect to a brave soldier that we lost today. Sub-Lieutenant Abigail, she's a brave soldier and she served her country really well. My heart really goes to her family and also to the 5 other members that are still missing. So please do keep them in your prayers. So as we go forward, week 6, week 7 of the lockdown, things are changing by the day, but definitely not getting any better in terms of the business environment and the difficulties that we are experiencing, not just in terms of, the healthcare issues, the losses that we are having, precious life that are lost, but also the toll is taking on businesses and individuals. So we every other day, we are bringing to you these interactive webinars so that we can help you in gathering some really useful information that can help you as we slowly bring our economy back on track, as we slowly bring our business back on track. And through this, what we intend to do is to make sure that you are ready for taking your business, reclaiming your business, making sure that you are having all the information that you need, whether it is government programs or whether it is, things that you need in terms of, the guidelines to get started so that we can enter the recovery phase and get our economy reopened. As part of that series, we wanted to take a look at what are we going to do going forward. We're surely not going to be in this phase forever. We will reopen and we will recover. And as we do that, there are many issues that we need to take care. This downturn has definitely impacted a lot of businesses. There's businesses that will be devalued. Of course, the stock market is crashing. We'll see devaluation in real estate and so on. So a lot of assets that we have will be under severe risk of getting devaluated. But what can we do at this time? How can we protect our investments? How can we protect ourselves, our companies, and what we can do about our future? What strategies can we have that we can deploy so that we can improve our bottom line at this time, and make the most of the opportunities that exist. So to provide more information on that and to walk us through those strategies, to provide more insight on what can be done, we have with us a local expert, Sandy Anderson. She's from Grant Thornton, which is a leading Canadian accounting firm, which has got an operation in Windsor-Essex, and they provide audit and tax and consulting services to private and public sector organizations. Sandy's been with them for several years, since 1995. She's worked at both large, national and mid-sized accounting firms. She's their current regional leader for Southwestern Ontario. Sandy has also been a business woman, an entrepreneur herself. She used to have her own consulting practice, and she's very well aware of the issues that small business are experiencing at this time and what should be done or can be done. And she's leveraging her background to help clients navigate an ever-changing tax environment, especially in today's world. And for the past 12 years, she's been a facilitator for CPA Canada Income Tax Practice course for general practitioners. And she regularly presents to professional associations on many range of issues and tax matters. She's also the treasurer of Windsor-Essex Child Youth Advocacy Center and a member of the Windsor Chamber of Commerce. With that, I would like to turn it over to Sandy. She has a presentation, and as always, if there is things that you would like to ask, please make sure that you put that in your chat, in the chat box in the QA section, and we'll make sure that we cover that post Sandy's presentation. So with that, I'm going to turn it over to Sandy.
Thank you so much, Rakesh. I'm just going to get the presentation set up here. Bear with me while I work through this share screen scenario. Marina, is that coming up?
No, not yet.
Okay, I've got it up on here. Let's see.
Okay.
How's that?
Yes, I
Yes,
see
we
that.
can see it now.
Yep.
Okay, excellent. Okay, good afternoon, everyone, and thank you so much for joining today's session, and thank you very much to the Chamber for hosting this series to help our businesses in Windsor-Essex County. These are certainly unprecedented times for everyone, including business owners, and advisors are here to help. Since the onset of the government measures in mid-March to only allow those businesses involved in essential services to remain open, and the later updated list on April 3rd, the economic impact of the COVID-19 has become more evident, and we are experiencing that very close to home here for us in Windsor-Essex County. As we're all aware, the government has introduced significant financial measures to help alleviate the impact to business owners, and some of the assistance that we've all been taking, finding out more and helping clients with are the wage subsidies, of course. The portal just opened on Canada Revenue Agency's website on Monday to allow business owners to have up to 75% of wages. In some cases, it can even equal 100% depending on the calculation. So it's very important that you take a look at those measures and see if you qualify. Other things that are happening right now is enhanced lending arrangements, deferrals of payments of corporate tax installments and HST, amongst some of the other most talked about programs. But today's presentation is not about the government measures or about the wage subsidy. Instead, we are looking to the future as businesses navigate, and as Rakesh said, as you reclaim your business through recovery in the next 12 months, things may be turbulent. So what we want to explore is what tax planning opportunities are out there and what should business owners and their advisors be looking out for. The agenda for today is we're going to visit what's called an estate freeze or a refreeze planning, loss utilization strategies, an allowable business investment loss, tax efficient distributions, and some quick hits on corporate cash flow planning and opportunities for shareholders. Some parts of this presentation are very technical. Other parts, we will just try to put it out in a layman's terms. We're happy to take any questions at the end, and we hope that you find there's value in the presentation. So during an economic downturn, there may be devaluation of your business, the stock markets, and real estate. Oftentimes, this devaluation is very temporary, so this does provide a window of opportunity for us to take a look at some tax planning and possibly to lock in lower values to help reduce taxes on death, or possibly a future sale of your business, or to assist in succession planning of the business to possibly the next generation. So what exactly is an estate freeze? An estate freeze is a planning technique whereby you lock in the current value and therefore the inherent tax liability of capital property for one person in favor of another. Value of the future growth will attribute to another person, and we will show you and discuss a family trust, children, or who might that other person be. An estate freeze can provide taxation, estate planning, and business advantages, but it can also allow the current owners to maintain current control of the asset while the growth attributes to someone else. So let's just take a look at an example. So in this example, Mr. Jones has an operating company. That operating company was worth $5 million a month ago. In that instance, if Mr. Jones had sold his business, he would have a capital gain of $5 million. He might be able to claim his capital gains exemption, but he would pay tax on the excess amount. If there was an estate situation, there would be a deemed disposition of the shares Mr. Jones owns of OpCo if they can't be transferred to a spouse. And the taxes on death in this scenario would range anywhere from 1.33 million to 2.39 million. The reason for the difference in this is in an estate, we often have to take a look at what the underlying assets are and do some post-mortem tax planning. Sometimes we will be able to allow the gain that was triggered on death to sit, in which case it would be capital gains rates. And other times, in order to avoid double taxation, we may have to do a dividend to recover taxes, but that does result in a higher rate of tax. This is why we can't in this scenario exactly pinpoint, but we do know the range. Now, after COVID-19, potentially that business may have seen a decline and is now worth 3.5 million. This would be a good time for Mr. Jones to consider doing an estate freeze to lock in the value right now at 3.5 million, so that when the value later on goes and recovers back up to 5 million, he would have eliminated or reduced some of that estate tax liability. So how do we exactly freeze these shares? So the first thing that needs to be done is a valuation needs to be performed of the operating company. In the previous slide, we showed Mr. Jones as the sole shareholder, so presumably a value would be done of the entire business. And Mr. Jones would freeze his value by exchanging his common shares for a fixed value preference share. Now, the trick is here, we have to decide the business is still going to grow, who's going to own those growth shares. The triangle represents a family trust. The circle represents other individuals. Who will be those other individuals? It could be children, other business owners, family members. It all will be fact specific dependent on the circumstance. But this is essentially how an estate freeze is done, and it does require legal documentation to implement this series of transactions. Some key considerations to consider when doing an estate freeze is who will maintain control over the operating company, flexibility to allow for a future sale, a succession in a tax-efficient manner, possible multiplication of the capital gains exemption by the use of a family trust, and also some other family matters that can come into play, as we often see in family-owned businesses. So one thing to look out for, in addition to the estate freeze, before we move on to the refreeze, I just want to reiterate what you would be considering if you are a good candidate for an estate freeze is whether you have value right now in your hands that exceeds your lifetime capital gains exemption. What is your future plan for the business? If it's a sale, can we then bring in other family members who we may also be able to use their capital gains exemptions of? So if the value is declined right now, when that growth pops back up, you will have an accelerated value that accrued in family members or the family trust's hands. So this is in fact a good time to be taking a look at whether you should implement an estate freeze. Now, quite a few clients that we deal with have already done an estate freeze in the past. But their shares that they froze for, what happens if the company right now is no longer worth that amount? So let's take a look at the Mr. Jones example and assume that he had done an estate freeze a number of years ago at the $5 million mark. And at the present time, his business is now worth $3.5 million. What can be done? Well, Mr. Jones's freeze shares may have a redemption value on its face of $5 million. But if the company were to liquidate in value right now, and it could only pay $3.5 million, the fact of the matter is the fair market value of those $5 million face value shares is in fact only $3.5 million. So I've included a technical interpretation that CRA previously issued where they do give the blessing to allow a taxpayer to do a refreeze at the lower amount. So in essence, Mr. Jones would take his face value 5 million preference shares and he would exchange them for face value 3.5 million preference shares. This can all be done on a tax-deferred basis using different provisions of the Income Tax Act, and this is acceptable planning to the Canada Revenue Agency, provided the decline in value was due to not paying dividends on the common shares to purposely dilute. You do have to make sure you're staying within the confines of the technical interpretation and what is allowable. But definitely right now, we want to be looking for businesses who have done an estate freeze, have fixed value preference shares currently issued and outstanding, and have the value of those shares declined. Right now, there is an opportunity. So the benefit of the refreeze at the lower amount is that the freeze shares currently held are, we call it underwater, meaning they're just not worth their face value. So a lower value to these freeze shares may be desirable for estate planning purposes or possibly for succession planning purposes. Right now, if you want to transition your business to the next generation, sometimes people just want to gift shares to their children. The fact of the matter is you cannot gift shares without a deemed disposition at fair market value. We often like to match the tax effect to the cash received on a realization of an asset. And if you transition a business to the next generation as a gift, there is no change of cash in your hands, but there can be a tax liability. So in situations like that, a refreeze may be desirable. Subsequent to an estate freeze, right now, because the economic decline is specific to the COVID-19, now we're going to hopefully enter into a period of recovery in value after we get through this current situation. So on the recovery of value, if you've implemented an estate freeze or a refreeze at a lower amount, that recovery value should go to the other common shareholders' hands, be it a family trust or children. So we were just talking about an estate freeze with respect to a business. There's not only just operations that are being held inside corporations. Some people may have already realized the sale of their business and they have cash investments inside of a corporation. So we don't want to just think of an estate freeze from freezing an operating company. You can also do an estate freeze on an investment company. This situation here asks the question, what if Mr. Jones doesn't hold his investments in a corporation, but holds them personally in a non-registered account? You can still do an estate freeze in this situation. So what would happen here is, let's use the example of Mr. Jones again. And in this case, he doesn't have a business, but he has portfolio investments that had a cost basis of $3 million, and they were worth $5 million a month ago. So previously, the taxes on disposition of that portfolio investment has a $2 million accrued capital gain, and the taxes would be $535,000 on his death if there was an estate situation. If that value of that portfolio has currently declined in value such that it's now worth $3.5 million, there is a possibility to do an estate freeze. How would we lock in that tax deferral? So we would need to have Mr. Jones incorporate a new corporation. The common shares, again, would have to figure out who do we want to have this asset go to. So if we were doing this for Mr. Jones from an estate plan, we may take a look at his will and see where is he leaving his assets. And if it's to go to children, we might not want to have that estate tax liability on his death. So a freeze into a corporation would ensue. So how this works is Mr. Jones would transfer his investment portfolio to a new corporation on a tax-deferred basis. The portfolio itself may have declined in value, but may still be over the tax cost base. So there are election forms we can do to move these investments to a corporation on a tax-deferred basis. In this instance, whatever the fair market value of the portfolio is right now on the date of transfer, Mr. Jones would receive that fixed value preference shares as consideration for giving up his portfolio investments. So in this instance, on a go-forward basis, Mr. Jones would have some fixed value preferred shares, and when those portfolio investments re-increase in value, the future value would go to a family trust that he controlled, possibly with children as beneficiaries, or directly to the children as common shareholders. So the estate freeze and refreeze is not just for active businesses. This can also be done with investment portfolios. This can also be done in order to protect creditor protect assets if somebody has an investment portfolio and this is a concern. So freezing in favor of a family trust, for example, when the value re-increases, that value is no longer owned by Mr. Jones, so there's inherently some creditor protection. Just some tips and traps on the estate freeze and refreeze planning. When we're implementing either scenario, it's very, very crucial that we get the value right. We often, if it's a portfolio investments, that's usually easier to value rather than an active business that may be experiencing a current dip. The use of a certified business valuator may be helpful. In both the freeze and refreeze planning, we do have in the legal documentation what's called a price adjustment clause. And the price adjustment clause will allow a tax-deferred adjustment up or down if there's a discrepancy with Canada Revenue Agency as to what was the value on the share exchange. There's different, it is important though to make sure that to give effect to a price adjustment clause, there needs to be reasonable attempt shown at valuing the business and not just, scribbling on the back of a napkin. So that is very important to make sure that you get the value right. There's different sections of the Income Tax Act that can be used to implement a freeze or a refreeze. There's another thing that should be considered, which is called corporate attribution. This rule will apply if you're freezing in favor of minor children or a spouse. The CRA has some rules against income splitting, particularly if it's not a small business corporation. You may have to pay an annual dividend on your fixed value preferred shares, and the rest of the growth then can go to the other family members or whoever's owning the common shares. Another thing to be very careful of is if you're freezing an operating company or a company with portfolio investments in favor of a family trust, any beneficiary of the family trust is deemed to own those corporations' shares. And this can come into play if you're trying to multiply small business deductions, if children perhaps have their own operating business. It can also have an adverse impact if you do an estate freeze on an investment portfolio in favor of a trust where you have investment income and a child has active business income in their own entity. It could have an impact on the small business deduction that they're able to claim. So lots of different rules that have to be taken into play when you do the estate freeze or the refreeze. Family law issues are often considered when you create a new corporation, say to transfer the portfolio investments. You might have Mr. Jones subscribe for the shares on incorporation himself first and then gift those shares to his children so that there's a bit of a carve out under the Family Law Act. We also are always very aware if the person who's doing the freeze is a US citizen, because sometimes some of the sections of the Act that are rollover provisions for Canadian tax purposes are not for US purposes. If we are using a trust and we have non-resident beneficiaries, there could be, or US citizen beneficiaries, there could be additional compliance filings that come into play. And definitely we want to make sure we're considering in any freeze or refreeze planning shareholder issues, shareholders agreements, and how does that all play out. So the estate refreeze freeze is a good one to be on the lookout. It's a session in and of itself, but today we want to cover a number of strategies. So we'll just move on. Loss utilization strategies. Why do we have this as a topic today? Well, reality is likely going to be that a lot of businesses are going to see a temporary decline and a loss of revenue. Sometimes at the end of the year, when we're assisting clients to file their corporate tax returns, they may have multiple entities. And what's disappointing as a business owner to see is that you have one entity that had a profit that year, another entity that had a loss. Possibly, if those two had been together, there would be no income and therefore no income tax to pay. But yet, because they're in two separate entities, the taxpayer is left with paying tax in one and having losses in the other that can't be used. So we try to keep an eye on this throughout the year as these things are happening and utilize certain planning techniques to be able to make the taxpayer whole. It's interesting in the United States that corporate groups can actually file on a consolidated basis, so they don't have this issue. We right now do not have that opportunity in Canada, so we have to take a look at how can we make the losses in one company be available to another. So often popular, but not always my favorite use, is the use of a management fee. So here business owners will possibly reemploy themselves in the lost company and charge a fee over to the operating company for their remuneration plus a markup. And in that manner, you get a deduction in the company that has profits and you're creating income in the company that has losses. Management fees are a little bit tricky because you cannot retroactively do them. There's HST issues. There definitely needs to be some sort of services that the management fees are performed for. So even though they're a simple transaction, you know, CRA has challenged the reasonableness and the deductibility of management fees. So we always encourage that a management fee agreement is in place and it's followed. Some other techniques to use losses within a corporate group would be, let's say you have a land and building that has an accrued gain and you're looking to sell it, and you have another entity with accrued either capital losses or non-capital losses. You can roll the assets to the loss company and then sell as a strategy. You can also transfer certain equipment to a loss co and lease it back. You could use intellectual property and move it over to the loss co and have royalties charged back. There definitely is always the opportunity for an amalgamation of the two companies together, but presumably there was a reason why they were separate in the first place, and liability issues can come into play. So before we put any two companies together, we often will look at, are there other ways of using these losses amongst the group without combining the entities? Now, we do have to be careful when we're doing some types of these plannings that CRA does have rules that these can, a lot of them only be done against an affiliated group. And the definition of affiliated is a little bit different than related or associated. And that's the technical aspect of this part of the presentation. So the last thing on this slide here, how to move money between companies using a loss utilization strategy, is what we call a preferred share debt loop. I'm going to go through this one in a little bit more detail. So in this example here, we have a loss co that has accumulated non-capital losses, and we have a profit company that is continuing to generate income. The business owner does not, for various reasons, want to combine the two entities. So another option here is a preferred share debt loop. So how this works is, LOSCO would go to their bank and they would get a one-day loan, in this example, for $1 million. LOSCO would then lend the money to ProfitCo at an interest rate. ProfitCo in turn would take that money and it would subscribe for fixed value preference shares of LOSCO that have a dividend rate at the time of issuance. The money is now back in LOSCO and they use it to repay the bank. And the loop that's created here is every year, ProfitCo will be paying interest expense over to LOSCO, so it will have the deduction. LOSCO has the income, and then LOSCO pays the preferred share dividend back to ProfitCo for approximately an equivalent amount, moving the cash back to ProfitCo. The dividend between the two companies, we would plan to make sure that it was a tax-free intercorporate dividend. So essentially, you're using this to use up the losses in LOSCO. This strategy, it's not too often seen, but it's definitely an option out there and something to be considered in the future. The next item we want to go over is an allowable business investment loss. Now, an allowable business investment loss, if we're talking about this, and they're called ABILs for short, then this means that things have not gone well for the investor. So what we want to look for here is an individual who has lent money as a loan or invested in shares of a Canadian small business corporation. In the first illustrative here, there's no ABIL allowed company to company. And there's no ABIL allowed if you lent to an individual and then that individual lent to a corp. Your lending for an allowable business investment loss must be directly from the individual to the corporation. So what's so special about an ABIL? People will often come to us and say, you know, I invested in my business. You might see this loan as a shareholder loan on your books where you've put your own money into the company. And the company may not be able to pay you back. And they say, can I get any relief? And we say, well, you may be able to claim an ABIL. An ABIL is a form of a capital loss. But capital losses are only able to be utilized against capital gains. So this is often not very useful for the taxpayer. In this circumstance, if the capital loss qualifies as an ABIL, you can take an allowable portion, currently 50%, and you can deduct that against regular income, not just capital gains. So an ABIL is just a capital loss that's special. So there's definitely some key considerations to take a deduction for this. And this deduction can be used against employment income, investment income, anything that is taxable income. So some key considerations to be here is, was the corporation a small business corporation? Did they cease? When did they cease operations, if they ceased operations? And has the shares or debt been disposed of? Or can you deem them to be disposed of during the year under certain conditions? So this is, again, a very technical section of the Income Tax Act. We don't like to be in this scenario, but this is sort of at the end of the day, if we're just trying to look for some relief from our investment, can we take advantage of anything? Now, for those people, those tax advisors who have claimed an ABIL for a client, we know that this is a highly audited item by Canada Revenue Agency. They send out extremely long questionnaires. They will want to see how that loan or investment to the company was made or built up. And they'll also want to see, was it incurred in order to earn income? And this can be a little bit tricky if your loan is made up of a shareholder credit owing to you and you never charged interest on it and you didn't loan pro rata to your shareholdings. So we'll move on from the allowable business investment loss. We're hoping we don't enter into that arena. What is very interesting right now that people are looking at is how can I save money on personal tax? We want to defer and lower corporate tax and pay as little corporate tax as possible, but we also prefer to pay as little personal tax as possible. So on this slide here, we're just making an observation. So we've listed out the 2020 current rates for salary, dividends, and capital gains. And the observation here is if you're a high rate taxpayer, meaning your personal income is over $220,000, your effective rate on that income over that threshold would be 53.53%. The very bottom capital gain bracket personal, the rate is 26.76%. This is exactly half of the salary other income because right now capital gains are only half taxable in Canada. So this provides an opportunity for us to be doing some remuneration planning to owner managers based on using capital gains rates. So I'm going to take you through an example of how we can do this. So a tax efficient distribution is an alternative remuneration measure to extract cash from a corporation at capital gains rates as opposed to salary or dividends. This can create a savings up to 20.98%. basically, there are two ways that we would look at doing this transaction. If the beginning structure was, again, Mr. Jones owning OpCo, we can create a capital gain down at the operating company level, or we could create a capital gain at Mr. Jones's personal hands. Either way, the rates, if we look back up, the capital gain corporate flow through would be 28.97%, and a capital gain triggered personally is 26.76%. These are much better than a dividend of 47.74 or an eligible dividend at 39.34. So where we're looking for this is people who have drawn substantial amount of money out of their corporation during the year. Possibly this year they wanted to defer payroll source deductions, so they just took it as a loan from the company and then need to repay it. Sometimes they want to purchase a personal asset, so having the money inside of the corporation is not useful to them. So they ask, how can I get money out? And other people just have some larger spending needs. So when you calculate out taking a salary over the next 5 years and paying tax at higher rates, how much you net in your pocket versus doing a larger transaction right now at these capital gains rates, there often is substantial savings. So slide 22 here, we do go through an illustrative example for a taxpayer that wishes to remove $1 million out of a corporation. So the taxpayer's first choice might be, or option, to take an ineligible dividend. In this circumstance, the taxpayer on $1 million would pay $477,400 of personal tax. If this corporation had been a high rate taxpayer, meaning they had net income over $500,000, the taxpayer may be able to take an eligible dividend, which has a slightly different dividend rate of $393,400, 39.34%. Those are still very high rates, I think we can all agree, especially when we compare it to a capital gain rate. So the third column is if we create a capital gain at the corporate level, we would effectively pay $289,000 of tax. And if we created the capital gain at the personal level, the taxpayer would pay $267,600 in tax. So those are the effective rates that you see on the million, and the tax savings on a capital gain versus an ineligible dividend is $209,800. So often these transactions, because there is some planning that is involved, legal documents, creation of new entities, it's not a small transaction to undertake, but the savings, as you can see, can be quite large. So this is independent, individual specific as to whether or not this strategy is for you. But there may be right now, why we're talking about it, is the budget that was to take place on March 27th, that's been temporarily deferred. There was some talk that the capital gains inclusion rate might be increased from the current 50%. If the capital gains inclusion rate were increased, and in the past, during my years practicing, we've seen it at 3/4, 2/3. But since the year 2000, capital gains in Canada have only been taxed at half the rate, 50% being taxable. So we have seen a lot of these wage subsidy measures. We're seeing a lot of money being put out by the government to help us through these difficult times. A lot of people are wondering, how is all of this going to be paid for? And quite possibly the capital gains inclusion rate could be back on the table in future. So this may actually provide a window of opportunity right now to be entering into this type of transaction. So we just want to go through some really quick hits to be on the lookout for that may impact you this year. Some of these are measures that you won't see until your year end. Some you can address during the year. The first one here that the trigger we look for is any inventory that has declined in value. So when you're having your year end prepared by your advisor and having to file a corporate tax return, they will want to take a look to see if any of your inventory has declined below the cost. There is a deduction in the Income Tax Act that can be taken to write down to fair market value, the lower of cost or fair market value. This can be especially impactful for real estate developers who hold land inventory that may have declined in value. So it would give you a temporary write down and a deduction, which you could use this year if cash flow is more necessary than in other years, and you could lower your income tax liability, or you could even use the write down to create a loss and recover some taxes that may have been paid in the last 3 years. You'll also want to be looking for if there's an investment portfolio with any accrued losses. This can take place inside of a corporation and be used as part of your remuneration strategy. There were some new rules that came about, some of us are aware of in the last couple years. There were some clawback of the small business deduction if a taxpayer had too much investment income inside of their corporations or related corps. So a lot of people in the last 2 years before the rules were enacted triggered some capital gains so that they could minimize their passive income in the future. So right now you might want to be speaking to your investment advisors and seeing if your portfolio has any capital losses that you can use to carry back to capital gains to recover some of the tax in prior years. Now, whenever you're selling assets with accrued losses, investment stocks, you have to be aware of the superficial loss rules. The government will not allow you to repurchase that identical stock in the next 30 days. But that doesn't mean if you weren't invested in one bank stock and you sold it for a loss, you could for 30 days still stay in the financial industry sector and purchase shares of another bank and then jig your portfolio after the 30 days have expired. So non-capital loss carry forwards may be created this year if companies do see a downturn. You can carry those losses back. But you could also, if you had capital property, use those losses in the current year to, instead of just applying it to possibly low rate tax that was at a small business rate in a prior year, you could instead use those non-capital losses right now to sell in portfolio investments or otherwise any other capital property that has accrued gain, because non-capital losses can be also used against capital gains. But the trick with a capital gain is, because as we said, is only half of it is taxable, the other half that is not taxable can be removed as a remuneration from the corporation tax-free. So this is important because these are very different from capital losses. This strategy is using non-capital losses. If they're capital losses, it won't work because it reduces the capital dividend that can be declared out because the two accounts net together. So very technical again. So what we're seeing right now is some companies that maybe have a November or December, January year end that we haven't filed yet. And before the government introduced measures in March to allow you to defer your corporate income tax installments, these clients may have already made installments for the next fiscal year in 2020. So what we're looking at doing right now is you can log online with CRA and you can move balances between accounts. So perhaps you've over-installed on your corporate tax installment and may want to move it to pay your GST installment. You can call, I don't think you can do it online to move it to a payroll account. What you could also do is, let's say you're a December year end and you made some installments in January and February. You could ask your accountant to take those January and February installments and reapply them to your December 2019 year end, so that when you file the tax return in the next couple months, your refund will be larger. If you have not filed your last year end yet and you are expecting a refund, you're going to want to get that into CRA as soon as possible. And again, you might not have thought you were getting a refund, but if you take the previous example and move some installments over, it may help you generate some cash flow that's much needed at this point in time. Another item that's very interesting right now is uncollectible accounts receivable. So as we're having these year ends be done right now for December, January, or otherwise, we're taking a look at your accounts receivable to see if there's an allowance for doubtful accounts that can be taken so that you're not paying tax on the sale that gave rise to that accounts receivable. Now, the interesting thing here is that in order to take an allowance, the account had to become uncollectible during the year. So hindsight is always 20/20. Possibly if we had done that year end right at December, we would never have thought that accounts receivable was uncollectible. But in the current state, if that receivable is still outstanding, it may be doubtful now. The fact of the matter is you cannot take a deduction. It needed to have reason that it was uncollectible at December. So possibly at December, what you'll want to be doing is looking at how long was it outstanding? Was it over 120 days? Can you reasonably defend to Canada Revenue Agency if they look at your allowance and deny the deduction? An allowance for doubtful accounts is a little bit different than declaring a bad debt. Canada Revenue will want to see that you've made adequate attempts at collecting the bad debt, and who wouldn't want to collect their accounts receivable? But it's when you write it off as a bad debt that you usually recover the HST that you may have also submitted. So this also can create cash flow for you right now if you want to take a look at your accounts receivable. The last thing we're going to go through is just some quick hits opportunities for shareholders. These are just kind of high level. So again, the trigger of, if you're an individual shareholder and you have value in your company in excess of your lifetime capital gains exemption, we didn't talk a lot about the capital gains exemption today, but basically every individual in Canada can sell shares of a small business corporation that qualifies and get proceeds up to, this year, $880,000 approximately tax-free. Now, will those rules stay there forever? We don't know. We would hope that we would have some time, if there were ever any announcements, that we would be able to crystallize any gains to use any exemptions in the future. But if you do have a shareholder with value in excess of this amount, this is usually a really good trigger to consider an estate freeze right now. We have to minimize estate tax, but it could also be to minimize tax on a subsequent sale, a subsequent succession to the next generation. Another trigger to look for as business owners is, if you're a shareholder of a private corporation, do you only have one will? You really should be considering having a dual will to avoid probate. This legislation, this is still a viable planning point in Ontario. Different provinces have different rules. So we'd encourage you to take a look, make sure you're refreshing your wills. We've had a lot of people inquiring right now with the COVID-19. They're a little bit nervous, and so they are putting wills in place if they didn't already have one, or they're refreshing what they already have. Another thing to look for is preferred shares that have value. We talked already about doing a refreeze for a lower amount, but what you might want to do here is consider a structure that will allow for some share redemptions, or we could use those preference shares for the tax efficient distribution as opposed to salary in order to minimize some estate taxes on death. So we call this, if we do a freeze and then we start to redeem the shares, kind of in a wasting freeze or exhausting the estate freeze. Often we want an income split with lower income family members. There were some rules that came into effect a few years ago. We call them TOSI, tax on split income rules, that has severely limited our ability to pay dividends to shareholders who are not active in the business or who were never active in the business for at least 5 years. There's some limitations there, but we want you to know that it is still possible to income split with a lower family member. There's different ways that you can do it. You can create a capital gain like the tax efficient distribution up in the shareholder's hands. And if the shares were eligible for the capital gains exemption, this income, in fact, in this capital gain will not be subject to TOSI. Now, the trick here is in this plan, the capital gains exemption is not paid or claimed. The shareholder, when you trigger the capital gain, will pay tax on that. But as we saw in the observations, capital gains rates of tax are actually the lowest rate that you can pay on any type of income. So there are ways that we can use a spouse or adult children to still income split. We haven't gotten into today doing prescribed rate loans with minor children involved or to a trust. That is actually still a very viable transaction. The last one here is the multiplication of shareholders of a private corporation. If there's multiple shareholders of a private corporation, right now it's really important that we start to talk and you start to consider as business owners if you have a shareholders agreement. Often we see the most shareholder disputes arise when times are tough and money becomes tight. So there can be also unexpected results from COVID-19. So we want to make sure that all kinds of scenarios are covered in your shareholders agreement to protect all of the shareholders and to maintain the sustainability and longevity of the business. So That is all that we have today. I'm going to check with Marina and see if there's any questions that we'd be happy to take a look at and see if we can answer.
Thank you so much, Sandy. I think this was very useful. You shared a lot of tips, and to be honest, there's so much out there that we are not aware of, and this is a time to actually maximize, because business is hurting. We want to make sure that we take all advantages and all opportunities to improve the bottom line. So thanks for sharing that. We do have some questions, so let me go through that. But first, let me begin by asking that the SEBA loan that the government is offering, is that taxable? Is that a taxable loan?
I'm sorry, which loans was that, Rakesh?
The Canada Emergency Business Account loan, the 40,000.
Yes, the 40,000. Yes, no. So the 10,000, you mean? So right now it is just a loan on the books, and so they're expecting that you will repay most of that by December 2022. If you repay back 30,000 of it, then 10,000 of it is forgiven. If you have a debt forgiveness, that's actually quite interesting question. I'm not quite sure if the government has addressed it, Rakesh, or not, but usually on the books, when you have debt that's been forgiven, you will have an income inclusion, and you can shelter the tax on that by using either capital losses, writing down the undepreciable tax capital cost of other assets, or as a last resort, half of it would come into income. So if you had a $10,000 debt forgiveness, you may have to pay tax on $5,000.
I see. Okay. Okay. Thanks for that. And regarding estate freeze, can you please advise some pros and cons of using a family trust?
That's a good question, Rakesh. The family trust, again, it's been around for a long time. People often really like this because it is a vehicle that provides one of the most flexible possibilities for the future. So we usually try to, when we're doing planning with an owner manager, do a lot of what if scenarios. What if something were to happen to the shareholder? What if I sold the business? What if I want a succession, certain amounts to my children? So the family trust is nice from that standpoint because you can do rollouts at tax cost. So if you actually incorporated a company from the beginning and had the shares owned by a trust and they grew in value, you can roll them out to any beneficiary at the tax cost that was paid on incorporation. So that is a really big item there that people like to succession generation to generation. The other flexibility it provides is you don't personally then own the shares, so there is some creditor protection. Another opportunity is when taxpayers want to take advantage of a capital gains exemption on a future sale, but they're accumulating excess cash in the company. The shares will not qualify, nor will a buyer want to buy your cash. So you need a mechanism to get the money out of the corporation. And as we saw those high dividend rates, often the taxpayer doesn't want to pay personal tax, but wants the money out. The family trust provides a really nice vehicle to move money between sister companies without having an adverse tax consequence. So those are a lot of pros for putting in a family trust. Now, it used to be that you could income split then with family members by paying dividends. That, as we saw with the tax on split income rules, has been severely limited. There is still some opportunity. Some of the cons of putting a trust in place is that there are a filing requirement because it's an independent legal entity. So it has to file a tax return. Usually we have to do financial statements for it. You don't usually tax anything in the trust because it's taxed at highest marginal rates. So it just tends to complicate the structure a little bit more. That tends to be one of the biggest cons.
Okay, thank you. And you covered tax efficient distribution. Are there any risks involved in this kind of planning?
Yes, that's a good question also, Rakesh. So if the underlying assets are mainly cash or near cash, and this is part of a planned wind up of the company and a distribution of the underlying assets, CRA can assert that this was a dividend instead of a capital gain. So there's a lot of case law out there where these types of transactions have been challenged. And there's actually a lot of good case law in support of doing these transactions under certain circumstances. So you do have to make sure that we're taking a look at what this individual's position is. You also have to be very careful with the steps that you don't by accident trigger a dividend in another manner. So there is some risk that does go with it. but usually we try to adequately outline that for the taxpayer. And if they were taking the money out anyway as a dividend, a lot of people still understanding the risk will undertake the transaction.
Mhm. And if I understood this right, so for capital gains, you have to incorporate a new co, right? And then flow it through that?
Is this for the tax efficient distribution?
Yes, yes.
Yes, this is creating, I mean, if you owned something personally that had an accrued gain, you can certainly trigger the gain. But the plan is when you've earned the money in the corporation at those lower corporate tax rates, how can you flow it into your hands now personally at the lowest flow through rate? So yes, usually this is money trapped inside of a company. We'll often hear people, you know, maybe withdrew out a lot of money, they needed it, and they now need to repay it. And we say, you have to pay tax on that. Here, do you want to consider this? Or maybe they needed to buy a personal asset, wanted to buy a house, a down payment, things like that. So yeah, it definitely starts with a corporation.
Okay, thanks. And one other question we have is on wage subsidies. So the wage subsidy that's being currently provided, should a shareholder still consider a dividend strategy or otherwise?
Yes, we're looking at that too right now. So when we talked about, you know, maybe to not have to pay your payroll tax, maybe to not have to pay any personal tax, maybe a shareholder could just take a draw for the next year and call it a loan. And then in 2021, they could cover it with a dividend or a tax remunerate efficient strategy, and they could defer their personal taxes all the way till April 2022. But that is not to be said, if they qualify for that 75% wage subsidy right now, that is a really huge benefit. So perhaps while that wage subsidy is in effect, you might want to consider staying on payroll. Okay.
Great. Okay, just looking at if there's any other questions. No, I think you've covered it all. And we're right on time. So good job there, Sandy.
Okay.
Well, thanks so much. This has been very helpful, and we'll make sure that this presentation is also available on our website for those that would like to revisit it, because there was a lot of very valuable information that was very helpful. And for someone like me, you know, it takes some time for this information to digest. So I may have to read it a few times, you know, for me to really understand this completely. But thanks again for sharing this very valuable information. And for our attendees, you know, feel free to visit our website where you can see this presentation. It will be uploaded also on our YouTube channel, so you can access it there as well. Tomorrow, we are bringing in a special guest, Minister Melanie Joly, who is the Minister for Economic Development for the federal government, who's holding a very important portfolio at this time. She's the one that is working with all different business sectors, industry sectors to provide help. Including, you know, her involvement in terms of devising the various programs that have come out. So we'll hear firsthand from her in terms of what is out there, what kind of help is being provided, what are some of these programs that have been announced, and how it is helping. Again, what are some of the areas in which we can further expect help? Because clearly there is a lot that needs to be done. At this point of time, the government is just about applying bandage. It is still bleeding. So going forward, how are we going to, you know, take ourselves, the economy to heal? And that is what we're going to hear from Minister of Economic Development. We'll talk a lot about next steps, reopening the economy, the recovery phase, and questions specific to this area, to this region in terms of support for, you know, the manufacturing sector, the supply chain, and so on. So please do tune in for that. Our registration are still open. It is limited, but it is still open. So make the most of it. Tomorrow, it is at 9:45 a.m. It's not at 2:30. So tomorrow, there's a change in time, 9:45 a.m. So please register for that. And with that, I wish you a very pleasant afternoon. Have a good time, and we'll see you again soon. Thanks so much.